All right, good morning, everybody. Pretty good start to the week so far. We might just finally wash this out and begin working our way back up. So red around the world, Japan bleeding out the most, small caps right behind it, then the NASDAQ, S&P 0.75%, and the Dow down 0.25%. Now, there was a bit of talk this morning on the Mag 7 names being down, but really it's NVIDIA and Tesla. The Dow being down 0.25% kind of implies the blue chip stocks are doing all right, at least so far. Looking at Market Watch, they have the budget today. Really, the only thing that they are focused on. Something's wrong with FX Street this morning, so if it's not behaving, just give it a bit, circle back to it. You'll notice it doesn't give you a chance to log in or anything up here, right? I don't know, it's being a little weird, so we'll just skip FX Street. Finance Juice shows we have a couple of European central bank speakers, Bank of England. We're going to have some US Fed speakers. And then we have PPI today. These times are not accurate. It's one of the reasons I don't normally look at Finance Juice using the morning briefing. They're my time frame. That doesn't do you any good. We want market time frame. You can get that though, right? There's your broker's got it, TradingView's got it, everybody, almost every broker out there's got some form of economic schedule. I'm sure they're going to do a market wrap here in a little bit. We have the PM edition of Spot Gamma, which they were talking about the Qs and how it was underneath the put wall now where the S&P already was. And so now we got both indexes under there. It's worth a read if you don't normally read the PM edition. Go check it out. You might get a little insight into what's going on. Materially, we're in the same situation we were last week. We can see the dollar still holding its highs. The VIX elevated close to that $20 line. The 10-year under 4.8, but still really elevated, 4.4, 4.7. It's still really elevated. So we got the dollar elevated, the 10-year is up, the VIX is up. None of these are indicative of a bullish market or a market that's just in a pullback. So we want to straighten this out a little bit. Kind of be aware that with these up, if you're looking for a flip and a rally back, you can see how the NASDAQ and the S&P are both trying to come up a bit in this bear flag. If you're looking for this to sustain, then the dollar needs to fade, the 10-year needs to fade, the VIX needs to fade. Yeah, that is the 14th, isn't it? I was reading down one. So all those European central bankers, Fed speaker, PPI, that's on the 14th. For today, you got ECB rain and NY Fed expectations. Not a whole lot here. Hey, it finally worked. I've seen these guys glitch out before. It doesn't happen often, but when it does, just give it a little time. You'll know it's glitched because you won't have a chance to log in up here. Right now I do. Now you can see all the scheduled events for the day. We've got some auctions. And tonight we're going to get a little bit of data out of Japan. Then tomorrow, it really starts to expand with PPI and a lot of Fed speakers from around the world. So look how they position us into the end of the day for those events tomorrow. This looks more like a liquidity gap than anything else. So that's what needs to change. Get the 10-year moving to the south, the dollar moving to the south, and we should see the ES and the NASDAQ begin moving back to the north. We're underneath the zero gamma, the volatility trigger, the put wall. We're underneath everything this morning. The 20-day, the 10-day, the 10-week, the 3-week, all the moving averages were underneath those too. So any move to the upside has to fight through all of that. Now in the short term, and Spot Gamma kind of touched on it a little bit in the PM notes, when we're in a negative gamma environment like this, price, it can really move. We can make extreme distances in short periods of time. Typically, we're in a positive gamma environment. So when we try to break out, dealers will sell into that. And if we try to break down, they'll buy into that. So sure, we can get those rally days where we break out and we run and it goes pretty good. 1.5%, maybe 1.25% on the day. Good, decent breakouts. But most of the time, those breakouts, the dealers are selling into it. But we're in a negative gamma environment. And if we break out now, they will buy into that. And if we break down now, they will sell into that. So moves can be extended considerably in this sort of environment. So it is a trader's environment. I'm not warning that you should, sit out and not trade it. If you're a day trader, this is a day trading environment. Just be mindful that price can go a lot farther than you thought it was supposed to or that you thought it could. It also means there's not a lot left to catch us if we begin a significant move to the downside. So I think that pretty much says it all. Coming back down to this 5,800, that is the range that needs to hold. Spot Gamma is a website. You can go to Google and type in Spot Gamma and you will find their website. Every day I share their founder's note. So if you found this briefing, then you should have seen where I had also shared Spot Gamma's PM founder's note. The founder of Spot Gamma uses his own tools from the website and writes out what he's seeing looking at those tools. It's really insightful. If you haven't looked, then probably want to do that. If we break out of this box to the downside, We've got the flip point at 57.75. That's what I call the liquidity zone. And if we get through the liquidity zone, we've got opposite candle color at 57.07. Call it 5,700. Nice round numbers. 57.50 for the liquidity zone, and then 5,700 for the reversal on the OC. So this leaves us to believe it's either going to be a double bottom or an inverse cup and handle. Well, if it's a double bottom, we would expect it to go past the previous bottom, because double bottoms are bear traps. And what bear is getting trapped if we didn't even break the previous low, right? So we would expect to break that low and go lower than the previous lows so that bears will get in it so that we can trap it and we can run it to the upside. That would be a really good double bottom with a low that's lower than the previous low. An inverse cup and handle, on the other hand, would do the same thing, come back to the same point, but instead of breaking lower, we would look for it to pop to the upside first and give us the handle and then go. So inverse cup and handle, bearish pattern, bearish continuation after a little bump to the upside, probably back to 786 into that 58.81 area. We could overshoot that into the half, but generally your handles don't go that deep. And then we'll make our move to the downside. I can guess and assume as good as anybody else, but really those are the two scenarios. We just need to see them play out. We've got a long history where we get these moves to the downside 2, 3, 4 days in a row. And then we get that capitulation low where we try running it back the other way, like one of these lows. It gapped down way down here, and then managed to pull back up and close at 53.80. Not quite a cog line. 53.92 would have been a cog, and not one of the options numbers like 5,400, 53.50. So it kind of ended in no man's land, but it rallied back really well. Right, and then it stalled out. We didn't get that continuation for 3 more days before it finally took off. And if you remember, that was the August carry trade unwind, Japan rate hike, the VIX spiking into 65. It was pretty violent. We broke like some major moving averages during that move. But that recovery day was a really good day. We went from the lows around 52.50 and from the highs nearly 5,500. So a lot of room to move that day, a trader's day for sure. And there is a statistic that talks about no matter how bearish the day is as we come into the open at 9:30, no matter how bearish or bullish, no matter the bias, no matter how convicted you are that it's a bullish day or a bearish day, price can change direction in the first 30 minutes, 50% of the time. That's literally a coin toss. So don't get hung up or married to the idea that we're bearish today or that we're bullish today. You got to keep checking and making sure we're bullish or bearish. Here's another one of those capitulation style plays where it reversed and came back up, and we had that deep low, continued bleeding for days. Finally, one last hurrah event to the downside before it started the rally back up. If you go in the past, you can find a lot of examples of that sort of reversal on the S&P and the NASDAQ. We don't really have much of a wick yet at this point compared to some of those others that we were looking at. And we didn't come down to that round number yet, 5,800. We're already at the ADR half, a phrase I've said before you might get used to. If we get to one edge of the ADR early enough in the day, we can go to the other edge by the end of the day. Can't tell you how many morning briefing recordings that I go back and cut that section out where I said this, and by the end of the day, we were on the other side. Because it doesn't matter if we're bullish or bearish, it just matters what price does on a day-to-day basis. Two-sided market, we get both the upside and the downside. So we're here. If we break our own low and continue to the downside, then we'll focus on 57.77, which is down here. It's the full ADR. Otherwise, as long as we stay above that red line, it puts on the table going back to the other side. Today's floor pivot is lower than yesterday's. That's bearish. Price opened below it. That's also bearish. And so far, we haven't hit it. Normally, we'll hit that pivot point 80% of the time. So this is an MDP. It's a missed daily pivot. Today's channel is wider than yesterday's. A wide channel implies that even if we do break out, the breakout won't stick. Well, we're already broke out, right? We're outside of yesterday's range. That is a breakout. So a wide channel implies the breakout won't stick, which is saying we're very likely going to come back inside of yesterday's range by the end of the day. Just remember that these channels don't make price do anything. So it can suggest that breakouts won't stick, but it, one, can't make us break out, and two, it can't make us come back again. We're underneath the weekly floor pivot. This is the third week where we've been consistently below the floor pivot. Last week, we started above it and broke through it. The previous week, we were just completely below it the whole week. So we got this cog line from back here in November. Excuse me, the point of control, not a cog line. It's weekly point of control from 58.26 area. It's just below 58.32 cog line. And really, that's the last thing that we have any sort of help or supportive structure, because we didn't get much back here in September. That's not going to help us out. And looking to the upside, 59.50 could become a gravity point. If we get back above 59.11 cog line, we could start to drift that direction and as we get into this high volume node. But it's so far away, it's not going to be helpful at this point. Now, I was talking about August and Japan and the carry trade unwind and how there was some moving averages that were a part of that big sell-off. It was the 50 period. Generally, when we get below the 50 period and we're consolidating around it, we can hover quite a bit. So let's just kind of zoom in here a little bit. Orange is the 50. And you can see how we were above and below, above and below. These real violent days where we made really big moves. It kind of fits the market environment that we're in. And then it sold off violently, and we almost made it down to the 200. 3 days in a row, just real violence. But it was global participation in that move. This time, the swings have been much wider. We haven't been so tightly consolidated around that 50, but we've been consistently putting in these lower highs. We were getting equal lows, slightly higher lows. Obviously, that's done now. So we've got a full set. This is a trend. If you got 2 higher highs or 2 lower highs and 2 lower lows, you've got a trend. So obviously, we don't want to go to 5,600, which would bring us down near those moving averages that we had back here. $57.30. Yeah, 57.30 cog line could be a nice place to flip it and get it back. And if that don't hold, then 55.50. So one of the things we try to focus on is these pullbacks. So in the S&P, a good pullback is about 5 to 7 points. You can get the occasional 10-point pullback. But really 5 to 7 is the sweet spot. You know, they always talk about buy low, sell high, catch them on a pullback. And then when we actually get a pullback, everybody's freaking out like, oh no, we're going to go into a bear market, sell everything. Just realize that this is the market you've been waiting for. It's very likely the market that you've been training for. It's that 5 to 7% pullback before we get that next leg. It's not this bear market from back here, that 2022 bear market. It's just a pullback. So 10-day, 30-minute volume profile with TPO. 59.50 is the point of control for both of these. And it's not going to move anytime soon like we were talking about last week. I don't see how these are going to shift higher or lower at this point. We'd have to base and consolidate around, say, this 58, start building it out. And right now we've got no indication it's going to stay there and do that. We have a new VPOC from Friday. Well, no, never mind. We already cut into it. All right, never mind. So the textbooks will tell you to carry that line forward. If you don't have enough pivots and you want to carry forward yesterday's, why not? Right? I've got enough. I don't need another one. I'll just keep the VPOC. Otherwise, a move to the upside today, watch for 58.65. That would be Friday's point of control. It's where the greatest amount of volume took place. So it's very likely that if we get back to that, there's going to be a response in the market. All right, we were looking at this Friday. It gives us a preview of the new week. But of course, on Friday, it's only a preview. It's not set in stone. That range is last week's range. Compare that with this week. We've got more range this week. Now, to be fair, the range is based on two bits of data. One is time, and then the other is volatility. Last week was a 4-day week, so there wasn't as many days as there are this week. And then there's volatility itself. So at this distance, it really just looks like the added range on how far we could move is based on the fact that we have 5 days that we can make that move in instead of 4 days like last week. $57.57 is the week's range on the downside, and $59.65 is the week's range on the upside. We're thoroughly below the 10-day, consistently maintaining this structure. It's likely that we get another retest on the 10, that we can run up to it, test it. But right now we are just tripping to the downside. We'll be looking to meet that requirement. 8 to 10, 5 to 7. Once we go lower than 10% off the highs in the S&P and the NASDAQ, it generally gets people's attention. Not to the point where, they'll come in and play save a hoe or run the plunge protection team, not at only 10%, but it'll be how fast we got there too, right? If we get there really fast, then yeah, they'll run everything they can run at it. But if we're just grinding to the downside, they won't interfere at 10%. We'll need a little more than that. That's why this really started to bring things around when those 3 days dropped the market so fast, right? From 57.25 down to 52. 500 points in 3 days generally gets their attention. So looking at the 10-week, we got that grind to the downside started consistently below this, but the blue line is still above, sloping lower and lower, sure, but we're not there yet. 1.68% below the 10-week. We've been lower than that before. See back here in late 2023. That's when Yellen got into it. But Yellen's getting replaced, so we're going to have to deal with this new guy. Either way, otherwise, if we kind of discount this one, around 2 or 1.75 area, that's generally where our turning point has been over the last 18 months. So we're near that point. Over the last 5 days, we've got energy in the red, healthcare, or energy green, healthcare green, and building materials basically flat. I mean, it's green, but it's flat. Otherwise, everything else is negative by at least 1%, which was industrials here. But the rest of these that are down 2% and almost 3% if we're looking at technology. So in the last 5 days, 6 out of 9 of our sectors are down about 2% or more. So if we're looking for, that collective rising tide to lift all boats, we're getting a high correlation market coefficient. I know that's some nerd stuff to say very early in the morning. The threat is when everything is moving in the same direction, I know that sounds like a positive, and for traders it is. You got a higher conviction when everything is doing the same thing. But that's when really big moves can take place. These top three are what we call the risk on sectors. It's our bullish backdrop. So it's what's been carrying the market forever, right? Your Mag 7 groups, technology, consumer discretionary, microchips, Tesla, frivolous spending, banks, financials, software, technology, communications. Those have to turn back or there is no rally in the market. Chips are down, Bitcoin, the Mag 7 specifically, precious metals, gold miners, banks, retail. All of those are down at least 0.5%, which is the benchmark that I use because we do this so early. If you're going to circle back and do it closer to 930, use a higher benchmark like 1% or even 1.5%. Looking at things that are up this morning, I mean, it's a pretty small list. You got the VIX, Nat Gas, which is a joke, and then energy, specifically XLE energy, which is just a mosh pit of things. XXX China is up, funny enough, but it's down over 16% in the last 5 days. So that pop in China, very likely a dead cat bounce. So basically everything is down or near flat, waiting on the open. And we likely won't get the data that we need to move this market today. So you can watch the news, see if they come in running their teeth. But it would be from news, it would be from somebody speaking, because we don't have any economic event today of note, not big enough to move the market. All right, we got solar up this morning too. So solar, crude, pot stocks, energy, ag. You don't want a bull market rally day on solar and pot stocks because that's not going to carry, right? It's not going to stick. So that's what I got for you guys. Watch the headlines. Look for some options flow that could turn us higher in the S&P or the NASDAQ. But otherwise, you need the Mag 7 to wake up and participate. I'll see y'all tomorrow.